I'd like to invite Yannick Blais-Gauthier of E&Y Canada to join me on the podium to introduce that next session. Merci Yannick et bienvenue.
Thank you, Venda. Good morning, everyone. Bonjour à tous. Bonjour et bienvenue à ceux qui sont ici en présentiel avec nous et ceux qui se joignent en ligne avec nous. I'm delighted to introduce our much anticipated CRO panel today. Joining us to discuss adapting in uncertain times are Piyush Agrawal, CRO at BMO Financial Group, Antoine Avril, CRO at Desjardins Group, and Deb Barnes, CRO at OMERS. My name is Yannick Blais-Gauthier. I'm in charge of the Financial Services Risk Management of EY. I had a chance to work with several CROs here in Canada. Change of panelists or? Okay. I had a chance to work with several CROs here in Canada and globally. And through our experience working with CROs in Canada and globally, we decided to launch at EY a CRO Center of Excellence. The vision of the Center of Excellence is to create an innovation hub where we gather some of our best experts in different fields globally, and we think and we ideate around what are the most pressing current challenges in our business. And we reimagine the risk management functions of tomorrow. So it's a pleasure to introduce the panel today. The theme of the panel is adapting in uncertain times. We can all see the headwinds in the economy, but in addition to that, and I'll share a little bit more about that, but the risk management landscape is being challenged by disruptive forces, and we can think about new geopolitical dynamics, access to new technologies, consumption of larger sets of data, better awareness on environmental challenges, and we could go on and on and on. So our ability to navigate this environment will require a strong capacity to adapt and to respond to emerging risks and new opportunities at the same time. Nous savons tous qu'il n'y a pas de changement sans risque, et certains risques sont prévisibles alors que d'autres sont beaucoup plus difficiles à anticiper. Pour les gestionnaires de risques, c'est impératif de continuer à évoluer pour rester à l'avant-garde des changements dans notre industrie et de bien gérer les risques qui en résultent. So now we will be asking this panel some tough questions, and it's not my fault. I didn't choose the questions. Regarding the real-world impacts for risk managers of this uncertain risk environment. So with that, I will now turn it over to our moderator, Tony Pecha. Thank you.
Thank you all. So having listened to Neil Ferguson just a while back, we probably should change the name of this panel from Chief Risk Officer panel to maybe Chief Uncertainty Officer panel, because a lot of the work that actually risk managers do is to deal with unintended consequences, and that's what resilience is all about. So the very first question is, which I'll open it up to each of you, and then we'll get your perspective from the industries or sectors that you represent here. So looking at the geopolitical situations, the very uncertain environment economically, and other factors that challenge us, what would you think is a scenario that you would dread going to the board of directors with and say, our institution under this scenario faces these challenges, and these are the kinds of resilience that we would put together to deal with that scenario. However, it's plausible, but not imminent. So maybe I'll turn it over to you, Deb, first, and you address it from a pension fund perspective.
Sure. Well, first of all, thanks for having us here. I think the scenario, as OMERS is a defined benefit pension plan, the scenario that is most concerning to us is one of stagflation. I think for that reason, like, it impacts not only the investment side of our balance sheet, but also the liability side. So that is a scenario that we're often running through our stress testing framework. I think when it comes to sustained inflation in particular, one of the things that's also we're thinking about a lot is how it changes the correlations within our portfolio and the impact of diversification. So where you have stable prices and you see a decline in growth, you often then see central banks cutting rates. But an environment like we have right now, it makes that rate cut environment very challenging. And so you then can get a positive correlation between your stocks and your bonds, and then the diversification impact within your portfolio changes. So it is something that we actively think about as a team. We run various stress test scenarios. I think that concept that Neil spoke about unintended consequences is something we also think deeply on. And I think it's also aligned with something we speak about as a team, which is unconscious assumptions. And just thinking about the new rate environment that we're in, how we calibrate our risk models appropriately, which means that we're putting less emphasis on backward-looking models because we're now in a structurally higher rate environment, and more emphasis on those stress testing scenario analysis tools.
Thank you, Deb. Piyush, from a banking perspective.
First, good morning, Tony, and thank you to you and GRI for having me here. Look, we live in the world of a polycrisis, so if I were to go down just one scenario, would be probably tougher. At any point of time, we're thinking about multiple scenarios in the polycrisis, and really, from a risk management, I think the audience would know it. Each of these, through our early risk identification, goes through the probability of what might happen and the severity of what might happen. And so if I bring those back from anything to a stagflation, a deep recession, a hard landing, to the housing crisis, a commercial real estate-led crisis, a cyber event, a big fraud, big geopolitical events, they all converge into what does risk appetite mean. And so that becomes, I think, the overarching feature of, dimensioning those. If I had to go to the board, I think the number one thing that's always scary and always we take into perspective is risk appetite in or out. What are you doing? Did you get it early, or were you told about it after the event happened? And the second piece is the industry is centered around confidence. And so which of these can shake confidence? There are those that move profitability, and then there are those that shake confidence in the industry. And so what you've seen south of the border was the crisis of confidence. So you put these in a P&L event, but then you also have a confidence matrix of what that does in terms of how you manage it. And I think, within these, there isn't a shortage of risk. So that's why we are sitting here, and that's why the risk community is here. Everything out here is either a big risk factor or an uncertainty that you're trying to quantify in certain metrics.
Next, Antoine, I know that Desjardins is a multi-product company, but maybe for this panel, you could focus on the insurance perspective of the global poly risks, as Piyush just mentioned, and what would be top of mind for your institution and insurance in general.
Sure, thank you, Tony. Bonjour tout le monde, happy to be here. I like coming to these events because I realize I'm not the only one thinking about all these dreadful scenarios all the time. I've been in the job as a CRO of Desjardins for about 6 months, and we've already seen a number of risk events happen. So there's a number of scenarios that, more importantly than the fact that we dread them, we try to get prepared for them. We have, so at Desjardins Group, we have a sizable market share in banking in Quebec, but we also have, as you mentioned, Tony, life and general insurance as well. And so it makes for a very broad scope of probable, dreadful scenarios, and I can think about a number of them that I would not be very happy to have to go to the board and report to. As we've seen over the last 6 months, I think there's a little bit of comfort in how the Canadian system kind of comes together in times of contagion and so on. And so that's you know, the macroeconomic and the market risk scenarios, if you will, we look at very closely. But they, you know, I think there's some comfort in sort of collective decision making in that scenario. So the ones that you know, I personally dread a little bit more are sort of more the idiosyncratic scenarios of something that happens to our institution, you know, through either our own fault or the environment. I will go with Piyush as well to say the ones that are a crisis of confidence, and I'm thinking really our members' ability to access their funds on the banking side, so anything that looks like a crisis of confidence on that front, and or in an insurance scenario, you know, so systems going down or things like that are really the ones that we will be very, very focused on. So, you know, I'm thinking probably the one that is top of my mind is combination of technology and cyber.
Great, thank you. I have lots of questions that are of interest to me, but I invite the audience to ask their own questions. So please use the Slido on your badge as Vanda talked about before. It's on your badge and it's easy to ask. So please, this forum is really for you, but I could go on asking the kind of questions that I'm interested in until I get those questions. So going back then to these uncertain scenarios, plausible but not readily imminent, as we talked about. Since the financial crisis, risk management has really looked inside and developed new tools, primarily in stress testing and other risk management tools that were there before but really have been developed at a new level to deal with the kinds of risks that emerged from the financial crisis. What new tools do you think we need to deal more with, not risk, but uncertain scenarios? Maybe I could start with you, Piyush.
So I think the number one tool which you know, we don't talk about much is really the development of stature of risk management. There are always in a big organization multiple views on what things might be, but for risk management to have the last word and have the stature to execute what it believes is very important. And that I profess every day, and I tell all my risk management colleagues in the fraternity that the independence of risk management to go in and make a decision is very important. The second piece that comes with that then is, in global banks like ours, every crisis may come in a different shape or form, but when you're a 100, 200-year-old organization, these have all happened in different forms. So reach out and develop playbooks that can be used multiple times. And so during the pandemic, playbooks were used. It was new, but the risk was not new. You've been through SARS, you've been through other health issues before. You've had an FX crisis through the Asian currency, you've had rates, you're seeing the sharp movement here. All of these manifest in the same way on how it's going to either impact people, the pressure on technology, the credit portfolio or your market risk portfolio. So at the end of the day, a coordination around the playbook and keeping those playbooks dynamic becomes super important. And then when you combine that, for the rare occasion there is no playbook, then it's really the collective instinct of risk management along with the senior team. And it's again the partnership between intra-firm to around, and you saw that most recently with what happened again with the liquidity issues in the banking system in the US, in the regional banks, is how the Canadian banking system came together under the partnership from OSFI, and we talked through these risks very openly just to make sure that the financial system was always sound and secure. So that playbook is there, and the independence of risk to exercise the playbooks actually provides a lot of profound strength in the way you go about it.
Great. Taking again from some of the cues from what Neil talked about, what role do you think learning history, specifically risk history, plays in making you a successful risk manager?
It's a good question. I do think like the best information we have is historical information. So understanding how things have played out in history is always a really great starting point. But it's more about the uncertainty of the future. I think we need the tools, and I agree that often those tools are relationships and the ability to have a really robust, what I would call an earthy, real conversation at the tables that require it. It's probably one of the best tools we can have. I think often we think about risk as a discipline that is focused on the numbers and the analytics, but I'd also say it's deeply a people business. And so, yes, I think history is important, but also having the ability to have conversations to really forecast into this uncertain future. And one of the ways we've done that, which I think is quite an interesting just thought experiment, is to run pre-mortems. And so unlike a post-mortem where you look back at what's happened, you really reassess it, you're looking forward. And so I did this with my prior board ahead of a strategy offsite. We sat with each of the investment teams and said, on the assumption that the board is going to approve your strategy in a couple of weeks' time, now cast yourself 3 years into the future and assume your strategy is a catastrophic failure. And then with their senior team, they had to answer 3 questions, which was, what did failure look like? What were the signposts that failure was coming? And what can we do now to try and preempt that failure in the future and reduce the likelihood of risk? And the chair of that board said it was one of the most effective exercises in risk management he'd been in, because it was taking what had maybe been a challenge for the team historically, but it was much more future focused in its nature.
Thank you. Antoine, anything to add to that?
Well, I think we put a lot of focus on developing new tools as ways to quantify risk. But actually, I think, I work with the team a lot to go beyond that and sort of transcend the sort of probabilistic approach. And so I think I'm a big reader of science fiction myself as well, just for, because I like it. And it makes for difficult conversations when you go to the board with, science fiction scenarios. However, if you use, your knowledge of history as a basis for scenario building, I think that communication suddenly gets a lot easier. So I think we're always looking for new tools, but the important thing is how are you going to set up, governance, relationships as well, to use those new tools? Do you really need new indicators, or do you need to have, processes in place to act upon maybe the new early indicators you have? So that's what we're looking at quite a bit, and so it leads into the risk culture and how we sort of embed that throughout the organization.
Thank you for that. So prior to the SVB crisis that took many by surprise, people often said risk is pretty well managed when it comes to the traditional risks and the quantifiable risks. So the emphasis should be on the non-quantifiable risks, like cyber risk, climate risk, and so on. What's your perspective on that? Has that changed? Was SVB simply a canary in the coal mine, as they say, that maybe the traditional risks aren't as well managed as we thought they were, or was it something different? Start with you, Piyush.
It goes back to, complacency is a risk too, right? And so if people forgot liquidity risk management or treasury risk management is a real risk, then that's the wake-up call. It is sad to see an institution, or many of those around for 40 years or more, disappear in 40 years. And it goes back into what I said in the beginning. Banks are in the business of maintaining confidence. You have depositors' money, and how you manage that through trust is going to be super important. We've done very well in the Canadian banking system, through several crises over several decades, but it's very easy to lose. In my chair, I don't think there is one risk I ever talk about uniquely in that silo. Increasingly, and we've seen it now through repeated events, there is a heavy convergence of risks. So things that may emanate out of a fraud risk or a payment system risk flows into market risk, flows into credit risk, or even reputational risk that's hard to quantify immediately, but over the number of weeks or months, you will see that event. By the way, the new one emerging to me is social media risk. You think about today, the frustration between a customer not logging in and the microsecond it takes to go to social media and complain. And if you're an influencer, God help you, right? So that social media risk, trying to quantify that is something which we are waking up to as we go forward. So I don't think there is any risk where I would say is one or two. It's at the end of the day a convergence. You're reading about the headlines, for example, in China and the China real estate property. And I worry about that even though we have no exposure to any of those, because in the large Chinese real estate exposure is a hedge fund that then has linkage to multiple hedge funds that might be doing the free treasury basis risk trades with no haircuts. And so a cascading event of liquidity is going to go from a Chinese real estate developer all the way through the globe, depending on the size, the interconnectedness, and the magnitude. And so how we measure those and contain those goes back to risk appetite, goes back to a very healthy discipline around concentration risk management, and just what can go wrong, and when it goes wrong, how big is the impact that goes. So it's hard for me to give you one, on any given day, there's a new flavor of risk I worry about more. But at the end, I'm always thinking of a convergence of risks that will be across multiple risk dimensions.
I might actually just add in, if that's okay, as you're
Sure.
talking about the risks that really can bring down a business. Made me just remember a number of years ago, back in 2018, I was doing some study at a US business school, and one of the case studies we had was based on a UBS shareholder report from 2008, and it was looking at the real challenges that business faced and why they really got into this major subprime position. And so as a case study, I sort of went through it, and I had 3 different colour highlighters, and I was highlighting the different themes to sort of bring them together. And then a week after we did that case study, the Australian regulator published a report in the Australian Royal Commission on one of the banks in Australia. And it was about a 111-page report, and I had my same 3 highlighters, and I highlighted all the themes, and a decade apart, the themes were the same. And they were risk culture. And it was about not having the right escalation channels within an organisation, not allowing bad news to travel quickly to those who needed to hear it. It was about having incentives that were misaligned with the behaviour people wanted to see. And so I think, yes, like these external crises are really critically important. And we look at SVB and how we, prior to a few months before that, we ran a liquidity desktop exercise, which was really looking at a Chinese invasion of Taiwan and how that might stress some of our liquidity. And for us, SVB gave us an opportunity to pull out that playbook over the weekend and see, does it work in reality? And thankfully, it was, for our organisation, impactful. But I think if we can't get risk culture right, we can't enable people to have the tough conversations at the right table with the right individuals. That is probably the biggest risk an organisation faces.
We'll get to risk culture in a moment. Just sticking with the theme of uncertainty, what Neil talked about is in the political and economic situations where we need to rethink our assumptions about what's effective in this new world we live in, which things like geopolitical risk was probably not high on the agenda of most risk managers if you go back a few years. So what underlying assumptions do you think as CROs do you need to rethink in this new world? I'll open up to anybody who wants to jump in.
I can go first. I would say, first of all, bankers are bad politicians. Risk management is terrible politicians because we just have to speak the truth only one way, and there is, you can't bend it, you can't fix it. When you think about all of these scenarios, whether it's geopolitics or plain politics, it is not my job to take a view one way or the other. Rather, I'm supposed to be thinking about the max risk as well as the tail risks, right? In that, it's really a combination of the what ifs. And so as long as your scenario infrastructure and the people behind it are with you in the same vision, all you got to look at is what happens under different scenarios, and then you can evaluate your PDs or probabilities, or you can your severities are in that. And that's really it. The outcome of those, when you put them in the matrix, management, board, and others can say, yeah, I'm more worried about this or more worried about that. I'll take an example which you were referring to. If I go back to the financial crisis, what began as the housing crisis that flowed into then RMBS and then into CDOs and CDO squares, right? The credit losses on banks' housing portfolios was nowhere as big compared to what is happening in the RMBS market and in the CDOs. And so the scenario design, and you and I were both in the same institution, so we know this very well, Tony, is there was a misalignment of views on the housing sector that one group took a long position and the other group took a short position and they weren't talking to each other. And so the scenario design missed a few tricks that then allowed management to have a concerted view on where you need to be. So going back to the political or geopolitical question, all of these events in different forms have already happened. And I take the unbiased view of, let's scenario build it. If I'm pushed and somebody says, what do you think is more plausible, based on those, I can take the action. But we're not in the one trade a day business. You're in it forever. And in that, your risk appetite is supposed to be very tight. If you've defined your risk appetite that's well understood, and then you see the scenario outputs, you're supposed to mitigate or hedge to come back even at the cost of profitability. And so that's the way, the conversation is always around the scenarios and the risk appetite and your position at the end of that. And you can't get there immediately, you won't get there overnight. But if you've thought far ahead, because these are early risk indicators giving you a sense of where the big risks are, that's what's going to force you into what things you cannot do or what you will do more of to try and stay within the risk appetite.
Antoine, in the insurance industry, what major assumption do you need to rethink or challenge?
Well, so we have, basically three different businesses that provide, diversification. And so when you see, one market move could be beneficial to one side of the business on the banking side and then detrimental to sort of the life insurance or the general insurance. We also have to deal with different time horizons. So, if you're in the general insurance business, your policies are renewed pretty much every year. If you're on the life insurance, it's the other way. You're definitely a way out in the spectrum where your liabilities are really longer term, and somewhere in the middle you've got banking. So we spend a lot of time looking at scenario analysis or stress testing, but we generally assume that when things are going to go bad, correlations are going to increase, and so your diversification factor is not something that we take for granted. So I think we will look into a number of scenarios, and there's a lot of experience to be gained from just the different time horizons, the different tools that you will be using in insurance. So for instance, in general insurance, and ESG factors come into mind as a great sector where we try to work to get some of our tools in general insurance, for example, flood insurance, and sort of cross-match that with the data for banking and see, if we can get better readings of our physical risk. So, I spent a lot of time on probabilities, quantifying risk. But at the end of the day, I will always push our teams to sort of take the step back and think about, building resilience more than trying to avoid risk or trying to mitigate risk. At some point you're going to get hit. So do you have sufficient buffer? Have you thought about the sufficient universe of scenarios? Do you have the capacity to get back on your feet if you get hit?
And certainly there's a lot of focus on building resiliency in the financial sector, and the way we've been thinking about it is more on, when a loss happens, what do you do? But it's probably, taking Neil's comments again, it's really most effective tool that I'm aware of for dealing with unintended consequences that we face daily as chief risk officers. Deb, maybe from an investment asset manager, pension fund perspective, some would say China was a sure bet. I don't think that's prevalent today, so that's one of the assumptions that's changed. What other assumptions in the investment field that you think requires a rethink?
I think we're quite similar in thinking about just the correlations. I think for a long time people have thought that for the last 15 years that bonds are a really effective hedge in a portfolio, and that may no longer be the case for a period of time. And so one of the things that we've been looking at is what is the most effective hedge if we find ourselves in a period where we have sustained high inflation and a downturn in growth. And the one factor that we can find that persists through time is the strength of the US dollar. And so we're looking at, for example, in a equity context, if we have equities on swap, there's no US dollar offset, but if we put them into cash and it's unhedged, then we get some correlation benefits, or diversification benefits, I should say. So that's probably one of the key assumptions that we've been looking at recently.
I'm going to move on to a different topic, but before we do that, it's a very interesting question from the audience, so thank you for raising this, is how do you deal with maybe the skepticism, maybe the challenge that you have as you talk either to board or the rest of your colleagues in senior management about scenarios that may be plausible but could be dismissed as, that will never happen, or that's so remote, we don't need to deal with it. We have all these things we're dealing with today that need to be solved. So how would you approach trying to either skeptical colleagues or a board to get the right focus on these improbable but plausible scenarios? Any one of you?
Well, so not science fiction, right? That's for starters. But I think, there's a number of things that can help. We've had a number of crises over the last few years. I mean, everybody went through COVID. I think that was a kind of a reality check of it's not that you didn't see it coming. You could see it coming, and it's not like there's no historical precedent for pandemics. I assume we all had pandemic scenarios. Obviously, it didn't play out the way that we had forecast. We've had a data leak a number of years ago, and that was very impactful in terms of the culture of the organization. So I think going back to, again, history and lessons learned even recently. And then the other thing that we do, and I assume all of you do it as well, and if you don't, is just exercises. So once in a while we will take over the boardroom or the executive committee and run a drill, just like you would a fire drill, except a little bit more complex. And it's more difficult when you don't come out perfectly of any of these drills, and it's more difficult to say, you can argue until tomorrow that this scenario wasn't really realistic and you would have done it differently, but this is, it's tangible. We ran just a very, very basic test 2 weeks ago, and half the people we tried to reach on the phone didn't pick up in time. So, that's just a fail, very tangible. So it's a good, something that I think we should carry on doing on a regular basis.
Thank you.
I'll just say, when we do scenario development and we go to the board, I don't think any of us are planning a scenario when an asteroid falls on Earth and that's the scenario. That's not the part of risk management. So we keep those out of these discussions. And so if there's a thoughtful process of bringing up scenarios and somebody tells me, oh, that's highly implausible, and everybody says that, then that's the one I'm going to go after. I really am. I think the part about a risk team getting together with their partners and thinking about early warnings or early indicators and developing a scenario, it's very important. I have plenty of examples. This is where history comes in. When we've been told that's not going to happen, that's exactly what happened. I'll go back, I think 15, 20 years. One of my roles in my previous role, I was in India, and the dollar rupee was 45. Every economist said it's going to go to 40. Rupee is going to strengthen. By the way, just for context, it's 83 today. And at that time, I was stress testing the book for a 65 rupee to the dollar. And everybody said, you're insane. Not a single economist around the country had that. In 2.5 years, as I was leaving the country, the dollar rupee was 60, right? And so this is one of many examples I can give you when if you've got a gut instinct and you've got a team supporting you to build a scenario, it's going to happen. Who would have thought some of the largest superpowers or biggest countries are going to be, declaring bankruptcy? Who would have thought the biggest corporations we've grown up to see won't be around? These things happen. And so I think if you're going through that setup of scenarios, the role of the chief risk officer is also the chief persuasion officer. If you believe in this, it is your role to communicate to the board why you and the entire risk team stand behind it. And it goes back to risk culture, it goes back to risk stature. And I think that's the fun of our jobs, right? We get to be the contrarians in the room, but because we have a gut or a confidence behind it, it is our role to try and convince our stakeholders why we believe in these scenarios.
Exactly, well put. I mean, as a chief risk officer, you worry about when everybody agrees, not when there's disagreement in the room. Moving on to something more closer to home, the Canadian situation. Lots of highly leveraged consumers out there, housing prices under stress, lots, continued high interest rate for the foreseeable future, a recession probably in the works or maybe already here. How do you approach that in your respective institutions? So maybe start with you, Piyush, where a lot of consumers are going to be facing repriced mortgages pretty soon, and that could be quite a strain on your financial institution, but the industry in general.
Yeah. Well, I mean, I'll tell you, as an American coming into Canada, into my role, it was my number one worry. And given the concentration of housing, any risk manager is going to say, wow, that's a lot. But there are some significant, I would say, benefits or flaws in which I think the resilience of the Canadian customer or consumer is going to be proven time and time again. And so I think there is indebtedness, but then at the end of the day, between the G7 countries, you look at some of the macro trends or mega trends in Canada that actually give you pause for not worrying, in fact, have confidence. So you've got an economy in growth, right? You've got a significant shortage in housing stock. You've got this uptick in the economy coupled with a very low unemployment rate. It's ticking up, but nowhere close to history or nowhere close to what I call the worry factor. An immigration policy that's not changing. And so there is going to be, starting from the housing sector, there is going to be a continued shortage. So even though housing prices fell as rates rose, it was meant to, you're seeing that reversal happen, and there is a renewed growth for housing, and you're seeing the government come up with even subsidies to increase the housing stock. The second aspect beyond secured, and I feel good about the housing stock because given regulation and the pragmatic, I would say, supervision, where banks are in their housing portfolios, there's significant equity value for the homeowner. And the largest part of their wealth, if they're sitting in their home in a secured mortgage that is recourse to them, I don't think you're walking away because housing prices fell 5% in a year if you're going to live in it for 30, 40 years. And people are living longer, so there's going to be even more shortage of housing because people are living longer. So housing stock's not going to turn as quickly as the way you can. So then you go into the unsecured indebtedness, and that's cards and unsecured loans and some of the other stuff. I think the reaction you're seeing right now is exactly what is intended to be. The transmission of monetary policy is still happening through the economy. So you had excess COVID savings, people are going through that, there is still some left, but at the end of the day, you're meant to spend less on luxury items and focus on necessities, and you're seeing that in our own portfolios. There is a higher spending on groceries, food, lesser on travel, lesser on some of the other items. So I think I'm hoping that works out, because if that works out, monetary policy can reach a neutral rate or start the reversal where we would like it to be over time. So generally, I think in the ecosystem of the Canadian economy, the Canadian consumer, while indebted, is going to come out equally strong through this. There is wage inflation happening. Incomes are going up. Think of the same person 10 years ago versus 10 years today, and with where inflation is and where rates are. I think wage inflation is also picking up. So I have much more confidence, and because of the concentration of the large 6 or 7 banks and how we work in the Canadian economy, I think my worry factor, while we scenario design everything, I am less worried in my base case around where that might be.
Thank you for that. One of the risks I face here is freezing to death, so that's why I'm shivering. So maybe we can adjust
Well,
the
Tony,
temperature.
can I just add to something Pierre said? I think our reading in terms of the housing market, in terms of credit, I would tend to agree with Piyush. I think what we're worried about are the long-term effects on access to property. I think the result is, with low unemployment, you're going to see, hopefully the real estate residential market. I am not overly worried in the short term, but the same demographic trends you're talking about, Piyush, I think are worrying from a sort of access to property. So from and we're a co-op, right? So the welfare of our members is first and foremost in everything that we do, and it's it's worrying for the younger generations. So it's something that we try to look into, and also I think in the short term we're going to be okay. The refinancing of 2025 and 2026. That I think is still worrying, because who knows where we're going to be in terms of rates. So the long-term impacts, I think, are still to be determined.
Thank you. Moving on then to emerging risks, and we heard a lot about AI. AI poses both threats and opportunities. Can you talk about maybe in your respective institutions, your approach to AI, not just from how do we control the risk associated with AI, but maybe using AI tools to better risk manage. So maybe if I start with you, Deb.
Yeah, sure. So we're using it within the risk team from an analytical engine perspective. So we've been able to use some really great machine learning tools to look at correlations between our public equity book and our private equity book and the sectors that they're exposed to, and how those correlations, we look at it sort of cluster analysis, and how these different sectors have moved in tandem over different periods and where those correlations split. It then generates some very interesting discussions about the intended exposure we have through time. And then from a governance perspective, we have a number of cross-functional working groups to look at AI governance more broadly across the organisation, and our board has asked for a deep dive in November, which we're in the midst of preparing for at the moment.
I think I'll step back and say, the chassis for banks is really technology. Right? At the end of the day, you think of the advent of what's happened to where we are now, and your comfort over time on your smartphone to do things that you would never do when it came out was a big deal. And so taking a picture of a check and depositing a check online without having to go to a branch or an ATM, and then the advent of so many things that have happened, has been a calibrated approach over many years. So AI to me is yet another extension of that technology into the future. Now, it is innovative, and while banks want to be innovative, we are, I would say, within the industry setup, the less innovative one, simply because innovation comes with high risk. So AI is in that realm. But I think you heard Neil talk about it, and as risk managers, we're always looking for pattern recognition and try to make better decisions from pattern recognition. If you put humans in there, sometimes there are places where human bias kicks in. And so very simply, a same credit deal on 5 different days by the same risk manager or 5 different managers will give you a very different outcome. I think these are places where AI can be helpful as long as it has proper guardrails around the way you deploy it. So never let AI get a brain of its own, but put guardrails around what are red flags, and AI's mission stops and the human takes over. So the whole approach of maker checker has been in existence in banks for years. The maker checker will happen initially with AI and a human. You will have an UAT phase until you get significant confidence. That's not going to happen. At the same time, you have to keep experimenting because AI is here to stay. Whether we like it or not, AI is here to stay, and we're using AI subconsciously in many of the things we are doing in life. So around processes of pattern recognition around, let's say, anti-money laundering. These are huge factories all of us have in every bank because we all have sacred obligations to protect the financial system. But what is AML? It is really pattern recognition of bad guys trying to get in through different mechanisms, and those are places I think AI can help. So we are experimenting, we are introducing AI in some of these, but in a very concerted way because it is innovative, it has high risk, it doesn't have too many proof cases yet. And so as we go forward, we will continue investing, and when it's ready for more mainstream, it will come in. But I'm in no rush on AI because I haven't seen the output cases of AI. Like I said to you, we are dealing with people's money. The last thing I want is AI sending Tony your money into my account or my money into somebody's account, and those things can happen. So until we find those guardrails, we're in the experimentation phase, and there are a couple of areas where I think the test cases will begin to work.
Antoine, unless you want to add something, we'll move topic.
Well, no, I think pattern recognition, fraud, AML for sure. I think there's also an opportunity for there's still so many sort of manual processes that you can build upon and improve through sort of limited scope AI. Probably safer, so safer because you're not using sensitive data, but I think there's still an opportunity to work on your cost base through AI as well.
So the general theme being lots of experimentation going on. There's a lot of potential. It's still early days, and it's widespread deployment within the risk organization. We talk topical emerging risk, maybe not so much emerging anymore, but climate change and ESG and so on. Do you sense that the tone has changed with respect to ESG? It used to be all the rage, maybe it isn't anymore. You see institutions like BlackRock kind of pulling back a bit. Is that happening at your respective institutions, maybe from an investment perspective, Deb?
We are talking about E, S, and G, and how sometimes they can be in opposition of each other, and really thinking about each one individually and giving it the space and the credit that it deserves. I think when it comes to climate for us, there's a lot of focus there, obviously, and as OMERS is a long-term investor, we're not just having a fiduciary duty on behalf of our current members, but members for many generations to come. So sustainable investing is incredibly important, but so is the S and so is the G. So we are looking at them almost as individual silos when it's necessary.
Okay, thank you. Unless you have something really critical you want to add, I'm going to move the topic.
Carry on.
No? Okay, Piyush?
I mean, on climate, look, it's a very political topic, so I'll be very careful of how far I go. It's a very hot topic, no pun intended. It's real. Like those who read science fiction, it's not fiction, it's really science, and you've got to believe in it. I think everybody has a responsibility to it. It was all the rage because everybody came out and fired the net zero bazooka. It was important because sometimes those are the tipping points. When every CEO, when every company comes and does that part, that's when smart teams come together, figure a way out. I think the challenge you're seeing right now is because of all of the other polycrisis, trying to overjump what the capabilities are right now and trying to, then the whole context of greenwashing is a risk. So the value creation from climate goals to the value destruction of greenwashing, those are pretty obvious. What I would say to you and the risk committee is I think all of us right now have a shortage of tools to really monitor, track, and assess climate risk. In the ideal scenario, I would love to have a risk rating on climate embedded in the credit rating of a borrower, whether it's an individual or a company. But right now, the number of vendors and the number of solutions can give me infinite answers on that same risk rating, which is not helpful in the way banks should be run. So we are in the experimentation phase through many of these. And so that's one angle. The second piece I would say is we are absolutely helping our clients in the transition journey. And so if you're a climate activist and you think carbon or hydros, heavy industries are bad, yes they are, but they're not going to change overnight. It's going to take some time. And so while there is a revenue component, the risk management component is to work with clients into the transition journey. And these are not a one-day event. We didn't switch from gas cars to EVs overnight. People are experimenting and going, and there's a few of those, and more will come. And it's a gradual journey which will take 10, 20 years, and I think it's the same for climate. So I think all of us are excited about that journey, the transition. But in that transition, there will be more financing to many industries that may seem you're financing carbon intensive. You're not really. You're really helping them on their own transition as we go forward. And look, you're seeing headlines and you're seeing governments backtrack, and because it has socio-economic problems with trying to go too green without the capabilities and tools. So, like I said, I'll stop there because it's a politically sensitive topic, but I think you get the gist.
And any of these topics, we could dive deeper and have much more extensive conversation. I encourage you during the break to approach our panelists and ask those questions. We have less than 4 minutes left, so I just don't want to leave out a very important topic, which is risk culture. And so I'm going to give each one of you an opportunity, since we have very limited time. One sentence, what would you say about risk culture that would be useful for the audience to know?
I'd say relationships are the foundation of everything.
Great. Piyush.
Risk is the A team. You are part of the strategic partnership for the CEO, and it starts with independence and stature. And I go back that you go into the organization and you enforce every day that your team feels that they've got a very strong leader and spine all the way to the top to make independent decisions any day and every day.
So we heard about influencing, we heard about risk stature. Antoine, what would you add to that?
Well, I would start with, for me, it starts with basic general curiosity and applying sort of constructive, skeptical thinking. Just go beyond the assumptions, question, ask. That's, I spend a lot of time questioning how we get to that result, and it's fun. I think that's how we get better.
And read history and science fiction. With that, please join me in thanking the panel.